Hey guys, how's everybody doing? Welcome to the afternoon live stream. I wanted to show you guys an interesting trade that I just saw on Mike Coe's broadcast. Jackson, what are you doing, buddy? Jackson, hang on. That's not for you, Jackson. You play with this. Jackson, you play with this. Gosh. All right. Anyway, I just saw an interesting trade on Mike Coe's broadcast called Open Interest. And I wanted to show it to you guys before the market closed. And I made a small fry version of it that you could do in the SPY. Let's see here. All right. So here is the trade in question. It goes out till May 1st. You could do it tomorrow too. Hopefully the market doesn't crash overnight, but I still thought you guys might want to see. All right. So here is the trade. So trades. Active. All right. It's the right here. It's this well trade. And this is a true trade that happened. I'm going to share the screen. It is a true trade that happened today in the SPX. It cost $5.7 million to put on, but it's worth $450 million if they hit it. Somebody else who's bearish and thinks the market's going to crash. It doesn't even have to crash that far to pay off. But we could do the same thing in, I don't know if I like it really, but I wanted to get you guys' opinion on it. We could do the same thing in the SPY, but right here, this is the trade in question. Go watch Mike's show. It's called Open Interest. I need to get the link for it. What this is a put spread in the SPX. It goes out till May 1st. And what it does is it's where you buy the 5,300 put and you sell the 5,200 put. All right. So, and you do it 45,000 times. This is a 45,000 lot trade. It was on his Bloomberg machine, but you can scan yourself also for big, well trades. You can subscribe to services like, unusual wells and all that kind of stuff. But this guy right here spent $5.6 million. This put he bought cost around $11.60. And the put he sold cost $10.35. So he saved himself a lot of money. He could have just bought this put, but he saved himself a lot of money. He used part of the money from this other put to offset the expensive cost of this put. Whole thing cost him about $1.25. You do it 45,000 times. That's a $5.6 million max profit. So how far does this have to drop? Well, it turns out this would have to drop about the same as we did last April, about 21%. To make this go in the money. And Mike Coe was thinking that's probably what they were probably trying to guard against is a drop like last April. And it doesn't even have to go all the way there to make money. If it goes, say by tomorrow, it's down, the market drops 15% before that or whatever. This is a $63 million winner, or say if it by April 11th, the market drops 15%. This is a $57 million winner. If the market drops, anyway, so the market has to drop under, it's a long shot. I mean, this is the kind of trade you hope it doesn't come true. So here's the small fry version of that. You could do the same thing, exclude. You do something similar, with the SPY. You could buy the 530 and sell the 520. Okay. The difference is about $1.40. You do it 100 times and you have 1,400 in the trade. So, I mean, this is for a disaster, but I mean, you have 1,400 in the trade. And if the SPY drops, it's a 98,000. If you can get the SPY to drop under 520, it's a $98,000 winner for you. And the SPY doesn't have to drop, just like the last example. If you could get the SPY still has to drop, but SPY drops 15%, it's an $11,000 winner for you. I put the link in Discord. Marcus has already put it on 250 times. Good job, Marcus. I would have just bought 500 contracts if I was you. This is a sure thing. This is, you could take this to the bank. Anyway, no. So what are these kinds of things good for? Let's see what it would do. So first of all, let's look at really the kind of drop. It's really a huge long shot. But let's look here. Okay. Here to here was 21%. Okay. So that's from top to bottom, but from where we're at now, where we closed at 670, what's 21% down? What's 20% of 670? It's 134. So take 134 minus 670. I'm terrible at math in my head. 134 minus 670. It's down here to about 520, right about where those strikes are. So you're making it would hedge if we went, all right, 670. So let's just do it. So it'd be 570 and then subtract 34. So 560, 550, 540, and then 4. So 536. So right here is the 20% line. Hope it doesn't happen. Mike was saying the same thing we've all been talking about too, or I've been saying the whole time, the wars don't end fast. This is going to get worse before it gets better. Just going by history, not making any kind of political statement, but just going by history, when we get involved in wars in the Middle East, and especially sending Marines to Corg Island. I mean, hopefully that will be a good decision, not trying to be political or saying it's a dumb decision, but you would think it might prolong the conflict a little bit. So this is what it protects against. So you need it. So it's a 530, 520. So your max profit line would be right here. I hope it doesn't come true. Your max profit line would be right here. But as you guys can see, if we could get it, let's look at the volume profile. I wonder if we want to go down and we fall out of this higher volume node trading around 678 that we've been in forever, and wonder if we fall, there's kind of a low volume nodes here where we kind of shot through, but the last kind of major trading range we had was major two-way trading where, was right here at 593. And that's also kind of where the last breakout was. So let's say we fall there and by April 15th or something. So let's go back to our handy little simulator. I'm calling this a sea lion trade, because the other one's a whale trade. I was trying to think of, sea lion. I was going to say a dolphin, but sea lions are cuter. They're the dogs of the sea. All right. So let's say we get to April 15th and we're testing that 550 area. Was that what it was? I've already forgotten. Let's see if we just go down and test this now. It's actually 594. Okay. So really not a huge profit of 594. It's only about a $4,000 profit, but on a $1,400 debit, that's not too bad. At that point, you could take it off and you could put like 3,500 in your pocket or 3,000 in your pocket, and then and then establish it again, take out another, trade similar to this. And then if it keeps going, you're in, or you could just leave it on especially if you have a large portfolio and you're using it as an overlay. So let me show you how that would work. So this is 100 lots. So, but let's say let's just simulate if you had, just simulate if you had 100 shares of SPY, what it would look like. So here's the profit loss on 100 shares of SPY. So if you were trying to guard a $60,000 portfolio, I mean, here's kind of the math on how that would work out. If the market drops, but not far enough, this trade's going to be a loser and your portfolio is going to be down. This is more like Black Swan. You need a big drop. But if you had 100 shares of SPY and we got a 20% drop, you would actually have a $16,000 profit. But whereas if you just had the 100 shares of SPY, you'd be way down without it. But then it depends on, where it drops. This is your ultimate. If the market does drop, the 20%, you could actually make a profit of $83,000. And that includes all the money you lost on your 100 shares of SPY. So wonder if you had 200 shares of SPY, or really it's a 100 lot trade. Wonder if you had 1,000 shares of SPY. I'm just curious what that would look like. Because, 1,000 shares is actually for a 10 lot trade. This is a 100 lot trade. So I guess this guards 10,000 shares of SPY. So if you had that, I think I did the math wrong on that. I think it guards, I think I got carried a decimal at the wrong place. No, not there. But if you had 1,000 shares of SPY, would this help you out? Let's see. Well, it doesn't really look like it would, did it? Well, anyway, if you need to hedge more if you have 1,000 shares of SPY, but if you had 200 shares of SPY, so you have $120,000 worth of a growth portfolio. You have a huge valley of death, but if you get the move, you could have an outsized gain. If we're down 20% and you have 200 shares of SPY, that's 120,000, 130,000. We're down 20%. That's a 26. You should be down 26,000, but instead you would be up 67,000 instead of being down 20,000. So anyway, I thought it was interesting, to say the least. Let's take the SPY shares off. Let's just exclude those. But if you just wanted to take a cheap gamble, you could do it 10 times for $140. And then if you're right, you can make $9,800. If the market crashes, you can make $9,800. So anyway, all right. I just wanted to come on and do the afternoon show early today because I want to take Jax for a jog. And I had some other stuff going on. Let me go over to YouTube and turn on monetization on this. I think that's why no one's really here. Because I just wanted to get this on really quick. So just in case somebody wanted to do it before the close, you could do the same trade tomorrow. I hope. Man, wouldn't that suck if it dropped 20% overnight? Oh my gosh. Anyway, somebody to put if you think about a trader that has $5.7 million in this trade, I mean, it's a pretty substantial bet. I mean, he's looking at making $500 million if he's right. So my guess, he's probably trying to hedge a big portfolio. It's probably a bank or institution of some type. So, be a nice problem to have that big of a portfolio, but that's a crazy, crazy trade. I love well trades. The theory of well trades is that maybe those guys know more than we do. So we'll see. And it could just be a guy that thinks the market's going up, but just wants to take a cheap shot, or it could just be a guy that's a gambler. I mean, that has a lot of money and he wants to he thinks the market's going to crash. It could be somebody in the Trump administration or somebody, I shouldn't say it like that, but somebody in the know that is like, I mean, it could be. Wonder if it's Jared Kushner. If it's Jared Kushner that did that, we need to probably all do it ourselves as well. I don't usually recommend hedges that are that far out of the money, but I'm not an expert. I'm just a retail trader like you guys are. So anyway, all right. So let's do some other stuff here. Let's see how the market closed out. It looked like it was rejecting earlier. Let's get it on a 30-minute time frame. It looks like it rejected higher prices and fell back into the prior day's range, which isn't great. Pretty much here's what it looks like to me. And this is the bear thesis, but there's a huge bearish gap right here between 674 and 671. And that was created from the overnight action from Wednesday to Thursday. What the heck happened that night? Well, anyway, the market cratered that night. I forget exactly why. So we left behind an imbalance of sellers, people that were wanting to sell it. What the heck? So let's just mark that off on the chart. The open to close gap is right from here to, from here to here, we're going to make this red, indicating we think there's overhead supply now, unless we can, I mean, buyers really want to get on the other side of this. So we got into this gap, and also I wasn't even considering that gap when I put these red lines out here. I put the red lines out there because of the low volume nodes. Lots of times the low volume node will reverse the direction, the last direction. So it went up into that. I mean, but a low volume node is another form of imbalance, and you can see it. Anyway. So, and I don't know where I got this one from. I think it's anyway, but those were the two sell the rip spots. It looks like this first one so far has come true today. But like I also said this morning, we could have a situation where we aren't able to get through this imbalance the first time. We sell off, which we have, I mean, and then we sell off tomorrow, but we make a higher low and then put an inverse head and shoulders, and then maybe take another attempt. See, if this is an order imbalance right here, then we theorize there's sellers up here. But we've eaten through some of the orders. The bulls came in here, and so maybe we have to hit it a couple of times, and then the people cancel their resting orders or something. And also, if news came out or something, the imbalance might get, the people that still want to sell this area might forget about it. But if you're somebody that's a bear and a professional, especially, you never want to sell the low, so you're waiting for a retracement, you can see it. That's just the pattern in these types of moves right here. That's where an amateur would have sold right here. Oh, shoot, this thing just broke down. As soon as it broke through this key support right here at 670, it just broke down. But a pro might wait for a retracement and a failure back to the trend line. Now, we didn't make it all the way back to the trend line, so there's always a scenario where, we could maybe at a later point go and take the trend line back. All right, so let's see what else is going on. That's the SPYs. Here's the Qs. Now, my lines I drew on the Qs, I drew 3 levels of sell the rip. It went right through my first one, but in my second one, but it looks like it did respect the third one. They're dealing with the same overhead supply right here, left behind from the gap between Wednesday and Thursday. And also, even if you didn't know about the gap, you can also see that this area in general hasn't had a lot of two-way action. Traders are comfortable trading at 608 or at 600, but right in between here, there hasn't been a lot of two-way action. So that's an imbalance right there on the chart. So in any event, we'll keep an eye on that one. Let's check out Bitcoin. We haven't looked at IBIT in a few days. All right, good job, IBIT. Now, IBIT's leaving behind opposite type of indicators. IBIT left behind a big bullish gap between Friday and Monday, and presumably, and also a low volume node. So presumably, if the low volume node is hit from the top side, presumably there might be buyers still here in this area, this imbalance, and maybe that might be a good spot to expect maybe a lower high or a higher low. A higher low, and then hopefully continue in the direction of the trend. So good job, Bitcoin. That's good to see, up 79 basis points. I like that. I like that. Let's look over here at real Bitcoin on Coinbase. Heck yeah, 74,000. You got to love that. Went right up to 76,000 in reverse, but we'll still take it. Just got out over our skis and came back to the previous POC. So a good sign in a bullish market. Right here, got out over our skis, came back to the previous POC. It's the old check the previous POC play. And usually on that play, that often will turn turn stocks around also back in the direction of the primary trend. So, and we hopefully that'll happen here. Anyway, Bitcoin has an entirely different look than the market does. Two different markets. To me, I mean, Bitcoin is is showing all the hallmark, is in a positive trend right now, and the market's in a bearish trend on the time frame I follow, which is 30 minutes, the 30-minute charts. So, different time frames might show you different things. If you're a swing trader versus a day trader, you have different things. There's no one answer. Two people can look at the same chart and see totally different things. This is all interpretation. I'm just giving you my read on it. All right. So, hey, Mark, what's up there? All right. Mark's going to be right back. I'm guessing he maybe needed to get another soda pop out of the fridge or something. Zenful Rocks is here. Well, hey, there's Zenful Rocks. Thanks for being here, bud. All right. So let's talk gold, silver, and oil. All right. So gold on the 30-minute chart. Let's look at this thing. I mean, it's balancing out at this 5,000 area, but it would be great for bulls to be able to take back this high volume node, get back in this higher trading range. We'll see if it can happen. Lately, that the short-term trend has been down. We have a series of lower highs, and also this right here, this, and this look kind of suspiciously like head and shoulders, which is oftentimes a reversal pattern. Like I say, it depends on what time frame you're looking at. Anyway, all right. So gold's on short term definitely not looking as good as Bitcoin. Let's check out silver futures. Now, the same kind of story here, at least on the short term. You look at a longer term chart of this, you look at a daily chart, it tells you an entirely different story. On a daily chart, I mean, I don't even know what to say about that. Let's look at oil. We'll stick on the daily chart. I'll just do USO. Wow. Would you take a look at that? I mean, my gosh. And look at all this bullish volume, all this block up here. These are people buying up here. I mean, yeah, they're sellers too, but man, this trading range that's developed is just insane here. Let's check out crude futures. Crude futures are the tail that wag the dog, or probably maybe crude cash are, but in any event, here's crude futures. I mean, you definitely don't want a reversion to the mean trade in crude, at least on this time frame. I mean, because you're looking at 78. It'll happen at some point. I mean, but it'd be great for the market if we could get a reversion to mean here. It'd obviously be great for the market. It probably means the war's over or something. There's been some kind of breakthrough. Maybe maybe the negotiation could be, maybe the Marines being on Carg Island will be enough to where both sides can negotiate and get some kind of deal and get this thing wrapped up. But just based on history, it's not, super encouraging. And it'd be one thing if the United States economy was in a good situation coming into this, but we've been teetering on the edge of, lots of bad stuff for a long time. The tariffs killed us. I mean, hurt us. All the government money printing over the past 5 years, you combine that with the tariffs and now the war and stuff. I mean, it's not great, but it doesn't mean it has to end bad. And hopefully we're closer to the end than the beginning. Okay, so let's look at these ETFs now. We'll start with blocks. Blocks is plus 1/3 of a point. All right, well, let's check out ULTI from Rex. Plus 1.8. Wow, good job, ULTI. Good job, ULTI. Well, I'm afraid ULTY probably won't be able to beat that, but we'll see. ULTY was up like 1.3 this morning, but I bet it's pulled back. It's up 1%. I'll take that as beating blocks. Like I always say, this thing is much, much, much improved. Good job, ULTY. Let's look at K-Yield. Let's check out and see how K-Yield is doing. K-Yield's like blocks. It's not up as much as you might hope or expect. Hey, thanks, Oracle. I appreciate the compliment, bud. Oracle just said he likes these. I appreciate that. All right. So K yield is kind of lagging compared to, it looks like ULTY and ULTI were the two best out of the four main divas. Those are kind of the four main divas: ULTI, ULTY, blocks, and K yield. But there's diva adjacents. I mean, WPay definitely has some diva-ish qualities. WPay pulled back and is only up 8 basis points. Well, all right. Let's look at Mago from Tuttle Capital, the Mag 7. That one's up about 62 basis points. These charts suck. Let me get this moving average. I was trying to show something, but it somehow changes the colors. All right. So Mago, I guess that's fine. Meme Y, that one's up 2/3 of a point, not doing as well as ULTI or ULTY, but it will take it. Let's look at what else let's look at QLDY, the lightning spread ETF. This one's not really a diva. It's just but it has some diva-ish qualities, and it's up double nickels, 55 basis points. Now, after hours, is down 1/4 point for some reason. Maybe one of their companies that's in it had earnings and is getting hit. All right. So what other divas do we have to look at? Let's look at WiMAX. WiMAX is definitely diva adjacent, plus 1.3. Heck yes, WiMAX. Good job. WiMAX looks much improved also. I mean, you could also call that a bear wedge under support, kind of like this right here. I mean, but whatever. At least it's going up for right now. Let's check out all WiMAG. Well, now WiMAG looks pretty good. Okay, so let's check out ISSB. This one is definitely a diva. Just doesn't get talked about enough. It's up 1.28, so it's doing well. That's good. ISBG is plus, well, look at this. It's plus 1% during office hours, and now it's up 0.75% after hours. Heck yeah, ISBG. I had to buy one of the two. I didn't want both of them, so I chose the other one, of course. That's just, I figured stocks and Bitcoin would be, K Gold already makes me nervous enough. I mean, so anyway. All right. So that's all for those. Let's look over here at my friend Rob's software, stocktools.app, and see how the entire sector's going. Now, what the heck happened there? No. All right. Well, I have too much stuff going on as usual. Oh, gosh. Let me get my email off of there. Okay. Here we go. Let's get some stocktools.app. All right. My affiliate code, if anyone's interested in trying this out, is you get a month free, I think. You get 2 weeks without even having to put down your credit card. Let's look at the dashboard, and then we'll go over here to the... All right, so SPY up 1/4 point, Q's up 1/2 point, Russell up 1/2 point, UVXY down, that's good, like to see that. Dow Jones up 1/8 of a point. This is 1987. I'm talking in fractions, but that is 1/8 of a point there. Gold is down 1/8 of a point, and IBIT is up 2/3 of a point, and XOP is up 1.75, 1 3/4. Boy, that XOP, of course, I mean, oil's bid. I mean, you guys know that. I mean, energy's the only one out of the sectors that are double green, that the trend's up, the short-term trend's up and momentum strong. But then the next is consumer discretionary would be the next most bullish, at least according to this, his system here. And this is out of all the S&P sectors. The worst one lately is healthcare. Okay, so let's go over here to the dividend or the income ETF analysis, and let's look at let's get a little daily action on the entire sector. See what we have to offer. They're all waiting for it to load. I'm going to shoot the breeze with you guys, see what you guys are talking about. We had a good discussion in Discord today about a lot of stuff. But there's some new funds coming out and stuff. Hey, David's in the house too. Hey, David. I guess it loaded. We'll talk later. All right. Look at this. COIW. How is WPay not up more? There's got to be something that's just getting murdered. WPay, I mean, it has COIW. It has HOOW that's up 5. It has PLTW that's up nearly 4. It has MSTW that's up 4. I don't even see how that's possible. Maybe they paid a dividend today and the dividend came out, but the charts aren't reflecting it yet. But it's Tuesday, or they didn't pay it. Maybe it went X today, but they don't go X till Wednesday or Thursday, I don't think. Anyway, it looks like everything in their universe is just setting the world on fire. The highest one that is not Round Hill is a leverage one from Defiance, so that really doesn't count. But the highest one that's not Round Hill, something else, is Coney. Obviously, Coinbase is having a good day. Heck, Coney with fully capped upside is doing well, but is not beating the parent. Coinbase was up 3.5. Coney's up 2.5. So anyway, but Hui looks good as well. YBTC, Abdi. We saw all these same ones earlier. Goop, TSLW, AMZP, BITX. I can't believe I didn't realize that one paid as good of a yield as it did. But anyway, we'll put that one on the radar. It's in the Max Factor now. So it'll be on the show next Monday night for Maximalist Monday. All right. Anyway, usual suspects. I've been looking at weeks. Let's just pull a month up really quick and see for the past month how we've been doing. All right. For the past month, COIW plus 34%. That is a massive winner. NFLW plus 27%. Why did I sell my WPay? I mean, I know why I did. I know why I did. And maybe this isn't over yet, and maybe I'll be glad I did. But in any event, but even old Coney, I mean, you know, Coinbase was up 28% for the month, and Coney was up 24%. It caught 90% of the upside. That's those covered call spreads coming into handy. There's no such thing as free money. You aren't going to catch more upside unless you use leverage, and even that's not free money. But the covered call spreads make it where they catch a lot, 80 or 90%. Where traditional covered calls, I would say, caught 50 to 60% before the advent of the covered call spread. NFLP, look at NFLP. This one's from Curve. Howard does a great job, and he's actually beat the parent. And he doesn't use leverage. He just uses active management. And I mean, he's up 23 where the parent's up 22. Great job, Howard Chan. CO2 beating Coinbase. Well, not beating Coinbase. PLTW, of course, the leverage comes in handy, 20% a week, and sure enough, parent's up 18. This one's up 22. So that's a nice bonus, a nice little bonus there. InFly doing great, catching about probably 75% of the upside. If you compare InFly from YieldMax to NFLP, which I have before, that's why it's still in here. From Curve is spanking them, dog walking YieldMax. Good job, Curve. At NFLP is a tough fund. All of the Curve stuff is. Does Curve have a bad fund? Or one that's just like a constant outperformer, especially where it's not the stock itself's fault. They may, but they seem to do really, I think Howard's selective, maybe more selective than the guys over at Round Hill, YieldMax, Granite, who just bring out 47 funds, a week. All right. Palti looking good on the monthly basis. Palti almost getting all of Palantir's upside. That's a good look there. Traders at Yield Max, thank you. MS2. Now, Rex does a really good job. Look at how MS2 has beat strategy by a pretty good margin. That's about a 25% premium. 12 to 6, yeah, or 33% premium. Good job. Good job. YETH looking good. Look, YETH from Roundhill beating Ethereum itself. And the YETH doesn't use leverage. It's not part of the W funds. I mean, I don't think it uses leverage. It's definitely not part of the W fund. So here's BITX just spanking IBIT. It looks like BITX is double levered, is my guess. And they fell a little bit short. I mean, they should have got 16, but they got 14 and a quarter. I'm just guessing. I haven't read the prospectus. MSTW beating strategy by about 30%, 20%. That's about right. Look at old Misty. Well, Misty's beating IBIT, but let's see how it's doing against strategy. Now, Misty against strategy is wow. Good job. Good job, Scott Snyder. Good job. Over a course of a month, Misty's up 12.5. Strategy's up 12 and a quarter. That's good. PayPal, PP, whatever it's called, PayPal, not doing as well. Baggy's been having a heck of a run lately. Generational run, Baggy. I mean, beating IBIT. IBIT hasn't had a bad month at +8, but Baggy's like, hold my beer, IBIT. I'll get you 12 and a half. All right. Well, that's a pretty good looking lineup there. What else do you guys want to talk about? Is there any? Let's talk about what else? Let me see. I have that's why I save Windows open. What was I looking at there? Silver. I do that sometimes just so I can talk with stuff about you guys later. No, that's nothing I want to talk about on there. I was trying to find the ETF we were talking about today. Well, let's just talk these income stacked. I want to see how this finished out too. We'll talk income stacked and then put any questions you guys have in the comments. That ETF we were talking about today is not even out yet. It's from Global X. It looks like it's going to pay 10.5% with uncapped upside, no stocks. It just has fixed income. So, I mean, it should be interesting. All right, we'll see. I think the ticker's ONEF, or yeah, I think it's ONEF, but it hasn't come out yet. All right, let's talk about stuff that has come out. So let's see what kind of day ISSB had. This is the income stack SPY plus Bitcoin. Now, what I did is I made my own metric so we can measure the managers. They just have 100% SPY and 100% Bitcoin. So in theory, they ought to make 4.158 plus 1.037 minus SOFR, which is the prime rate, or it's the lending rate the banks lend each other money at, I believe. It's like 4.3% right now. Right there, there's SOFR. I built it in where it changes if SOFR changes, and they'll change the calculation. But anyway, so these guys ought to be up 5.178 if they're doing a good job, because their goal is to do as good or better over time. Anyway, they're only up 4.815. That's on ISSB. That's a slight underperformer. So let me show you where that goes. Well, we don't have today's, but yesterday's. Anyway, this is every day that's gone by. They've been in business since January 22nd. This column right here is the outperformance. We want to see mostly red in that column. And we see, we want to see mostly green. We don't want to see mostly red. So anyway, they underperformed a little bit yesterday, and it looks like they're going to underperform a little bit today. But on the 13th, on Friday the 13th, they picked up 84 basis points over just passively holding both of them. They picked up 78 basis points the day before. They picked up 1.6% on the 11th. They had a huge week last week. Anyway, you average it all up. They've generated about a total of 14 basis points alpha, which is about 5.3%, 5.3 extra percent that they made. Now, let's check out the ISBG. Well, ISBG is right here. So gold was flat. IBIT was plus 4.158. So this thing ought to be up, whatever. Then you have to subtract SOFR. So this thing underperformed a little bit. The bench was up 4%. This is only up 2.5. I'm going to make sure it updated. But in any event, here's their daily return logs. The other guys were averaging 18 basis points. This one's averaging 17, which comes out to about 6.5% alpha. So good job. Good job, guys. You can see right here in their column, they get mostly green too. It looks like they're green now about 60, 70% of the time. But here's the dividend yield. They're very steady on dividend yields. These are the dates they got paid. Dividends have been 9 cents for the first 3 weeks and then 8 cents every week since. And there's the annualized yield, all that kind of good stuff. And also you can look at the rolling kind of total here. The yellow line is the actual asset itself. That's the ISBG. All right. This up here is how well gold's done. They would have been better off just to buy gold. Gold's outperforming them, but it's 100% allocation of gold and Bitcoin. Well, Bitcoin is this purple line down here at the bottom. If they would have just been in, so Bitcoin's down 17% over this time frame. Gold is down 10%. So when and the benchmark is this green line right here. So they've been above their benchmark the whole time. You want gold to be over green. I don't know if you guys could see that, but anyway, so yeah, it looks like maybe you can. Let me get this darn thing off the screen. All right. I don't know. I don't know why that, I think that just comes up. I try to only put that up at the end of the show. I'm not trying to beg for money. All right. But you can see right here over some periods of time, this yellow line was underneath the benchmark. Well, yeah, it was underneath the benchmark for a few days, but then as time goes by and they're stacking alpha, their idea is over the course of a year, they ought to drastically outperform just having both of them together. Now, once again, you still need the assets to go up, or if one goes up, the other one can go down, but you still want them, still need them to go up, just like anything else. But the really encouraging thing about ISSB and ISBG is the historical backtest. And the yellow line is the yellow line is Bitcoin and gold. And the purple line is stocks and Bitcoin. Well, if they would have started this January 1st of last year, well, in April, they would have got hurt. One of them would have been down 34%. Ooh. And one of them would have been down 12.9%. But everything else is down in April too. But the 34%, that's a pretty big one. That's stocks and Bitcoin. And that's pretty easy to understand because stocks were down 20%. And I don't remember how much Bitcoin was down too, but if it must have been down about 14% or something because together the benchmark is down 34. Anyway, this isn't how much they were down. They weren't around yet. This is how much their benchmark was down. Maybe they would have just been down 32 or something, but it still would have been ugly. The Bitcoin and gold one would have only been down 12.9 because gold would have been holding up the Bitcoin part of the pairs trade or whatever, the allocation. But then you can see they went from down, this one went from down 34 to plus 37. So that's a 60-point swing last summer. And you guys remember last summer, I mean, everything made money. You could throw darts at I made money last summer. Everyone made money. I mean, you could throw darts at a board last summer. I mean, gold was bid, stocks were bid, AI was bid, Bitcoin was bid. It was just a great time. I mean, but in any event, nothing lasts forever. But this other one, ISBG, the one that was only down like 10, 12% or something, actually went from down 10 to plus 80%. And that's just the benchmark. These guys say they can outperform the benchmark. We'll see. But then, of course, Bitcoin started selling off and stocks started selling off, and it hurt both of them. And if you still held it now from January 1st, in theory, the Bitcoin and gold one would still be plus 33%, just the benchmark. And hopefully the guys outperform it, and maybe it'd be plus 35 or whatever. But that's pretty decent. But the other one, stocks and Bitcoin, would be down 20% right now at this point in time. So, and then they were down. So that's obviously not great, but it is what it is. Anyway, did any of you guys have any of those stacked funds? I mean, they definitely have a little extra degree of risk in there. Because it's leverage. I mean, leverage works both ways, but man, if you get it right, what I did is on the day it came out, I bought the stocks and Bitcoin one. So let's see how I've done. And I should have bought the stocks and gold one, but I didn't want any more gold because of K Gold. I have some gold. So ISSB, and I haven't done great on this one so far, ISSB, and then we'll just look at SPY. And we're going to go from, it'll just go back since inception. It came out January 21st. Yeah. And, that early February Bitcoin sell-off was absolutely insane. But anyway, it is what it is. And then since then we've rallied back up. And stocks didn't look great either. And, stocks kind of, hang on here. Let's do it this way. Let's get SPY up here. So that's stock. That's what I'm calling stocks. And then let's do an overlay with, let's look at a little ISSB. And then let's do a little ISBG. And then we also need gold on here. Well, we need Bitcoin on here too. Okay, so then we'll go. Well, let's just look at those two first. Okay, well, that's not great, but not great at all. But in the time that has come out, stocks are down a little bit. I'm trying to get up. Oh gosh, I didn't want to do that. All right. Okay, so the green one is ISBG, Bitcoin and gold. And the red one is Bitcoin and stocks, or the blue one is Bitcoin and stocks. My apologies. Now let's just look at IBIT by itself, or Bitcoin, whatever. Bitcoin by itself. So Bitcoin by itself is the gold one. The gold line. Let's start them all together. Yeah, that's pretty much the story. So if you would have just had Bitcoin by itself, you'd be down about 16%. With the stocks in Bitcoin, you're down 12.9%. A lot of that's due to their management and the alpha they're creating or whatever. And then if you would have had stocks and gold, you'd only be down 7%, but gold's been more bid. I guess the other thing we need to look at is gold. So let's just slap a little GLD on top of this thing. And we're going to go same price scale. There we go. You could see, so the gold, but yeah, you'd be kicking yourself for not just going and buying gold, because gold would be up over the same time. But the gold has definitely helped out the stock allocation. Gold's +3. Bitcoin's -16. So you get one that's a combination of both of them, and it's kind of right in between there. I wish they would do one of these, and I've asked them with stocks and volatility, and they would manage a portfolio where they hedged each other. Because when stocks go up, volatility goes down generally, and vice versa. But they didn't seem interested at all. I don't think they think it would work. And I'm just a retail trader. That's just probably an oversimplistic view of the world. Stocks and gold. I mean, gold does hedge stocks, you know, lots traditionally. So stocks and gold definitely can make sense. And, you know, I don't know. Does anyone have that one BTGD? Let's see how BTGD did. Now it's from the same company, but they don't pay a yield. It's just a growth fund, but it's Bitcoin and gold together, no yield. So it'll do better than ISBG just because ISBG is doing the same thing, but it's paying a yield. So you're losing a little bit of money due to the yield. So Bitcoin GD. So, and that one is, where is that one? Bitcoin GD. Let me turn it off and on. Okay. So yeah, Bitcoin GD is actually doing, not doing quite as well as ISSB and ISBG. It's, you know, down about 15%. So in any event, all right. I'm glad Oracle likes these talks. All right. Yeah. David's here. Okay. So EDGX is beating T-SPY at the moment. Really? So let's check it out. EDGX. T-SPY. So EDGX did, I guess it came out February 18th. So heck yeah, it is. How does it look against ULTY? Ooh, sorry, EDGX. Sorry about that. No, they're all doing well. Or EDGX is doing well. ULTY is not a fair comparison for it. I was just joking. But it'd be, let's see how EDGX is doing against blocks. I bet it's beating blocks. No, not beating blocks. Let's see how it's doing against. That makes me feel good about these divas. I'm telling you, the divas just need the market to return. All right. K-Yield's beating EDGX. Heck yeah. Let's look at WPay. WPay smoking EDGX. Let's look at what are the other divas? What about QLDY? QLDY's smoking them. Let's look at ULTI. I mean, ULTI is looking pretty tough. Almost one. Is that an error? There's no way. I mean, but over the past, I mean, this is just such a short thing. Over the past month, I mean, crypto's been bid and meme stocks are coming back. Heck yes, ULTI. Let's see if ISSB is beating it. Yes, sir. Let's see if ISBG is beating it. All right. Let's see if Mago's beating it. I'm just running all the divas through here and the diva adjacents. Uh-oh. Mago, you're teetering. We're going to have to remove Mago from meme status if it's behind a Global X fund. Yeah, there's Mimi. All right. Well, heck yeah. Well, hey, Oracle, I appreciate that. You missed parts of it. It's your new favorite show. I really appreciate it, Oracle. Oracle, that's a very generous donation. You are the man. I really appreciate that. Were you guys surprised that, I mean, EDGX is good. Let's see if Spy Eye's beating it. Spy Eye's beating it. There's not, I know EDGX, or it has a good theory. I like what it says in the prospectus. It looks like it could be a good fund. It's a really small sample size. We're talking February 18th to, less than a month. So all this is with a grain of salt. Let's see if Triple QI is beating it. I'm telling you, the divas are doing a lot better than people realize. Especially over the last month, because they aren't doing great over the past 6 months, though. We could take, your standard fund from Global X, maybe like a QYLD, and run it against a diva. Let's see, for the past 6 months, we'll run it against K-Yield since inception. Well, I bet K-Yield beats QLD. I don't know. We'll see here. Yeah, no, it darn sure does. Now that's QYLD. That's not QLDY. So those are both divas. I was trying to type in the one from Global X that's been around forever. QYLD. All right, but it's spanking K-Yield also. K-Yield takes a lot more risk than either of those over the past 6 months. It would be QILD, which is the most plain Jane boring fund. That was my point, is smoking all the divas over the past 6 months. That doesn't, but if you go to the past quarter, let's go to the past quarter and see how the divas are faring. I bet they're still getting beat. So QYLD, and let's compare it to a diva. And K-Yield's definitely a diva. All right. QYLD, the steadiness, that's what happens. But it wasn't up as much. It wasn't up near as much. It looked, but it wasn't down as much. Let's see. I mean, they're all going to be, let's see if it's beating ULTY. It's going to be beating every diva. Let's see if it's beating WPay. Yeah. Well, but if you take the divas, to make the divas look good, you'd have to go back just a month, and all the divas are going to be smoking it. Well, maybe not WPay, but ULTI was the most impressive diva over the past month. Oh, that's the wrong year. Hang on. That wasn't a month. All right. Here's a month. ULTI has really turned it on lately. Really turned it on. That's the risk and reward thing. These ones that are super risky, if they get the market right, let's see. Let's see how K-Yield looks. Now, K-Yield's not even beating QILD. Anyway, I mean, all these funds we're looking at are risky, but I think they're good. Yeah, you're the man, Oracle. Thank you so much. Global X making a comeback. They said they were here first. I mean, let's look at, here's something. Okay, let's look at QILD. Here's the knock on covered call funds. You guys have heard all this before, but let's just try to illustrate it. So we'll go back since inception on QILD, and then we'll look at a guy that just bought the Qs. All right, so QILD paid you an income, but it cost you a ton in NAV upside. You could have I know you guys all know this, but you could have just bought shares of the Qs. In hindsight, you may not have known this at the time. You could have bought shares of the Qs and paid yourself. I don't know, 1% a month, 0.5% a month, 6% a year. What's the 4% rule? Maybe do the 8% rule. You have $1 million of the Qs, pay yourself $80,000 a year. That comes to 5,000 a month or something, 5,500 a month. And it looks like you would have come out better, but QILD on the other hand gives you about 1% a month. And so you have, that's 1% a month, on $1 million was 12%, right? 1% a month is 12%. So that's $120,000. Yeah. Okay. So it's $120,000, but you're leaving a ton of money on the table. And the other thing is, if you spent that money, which presumably you would, that's why you buy QILD, really you wouldn't be up at all. You would have gone from 25 to 17. So that's NAV decay or erosion or whatever. So if you had $250,000 of this, bought it in 2013, it would be worth $170,000 now. But you would have got that payment, and your payments equaled a lot more than your decay. You decayed $7-8, but you had $26 worth of payments. I mean, so there's the use case for it. It does a lot better than bonds. We could put QILD up here against a bond portfolio. And let's see. And it's smoking a bond portfolio and providing you more income. Bonds pay 4 or 5%. It depends. Sometimes they pay more, sometimes they pay less. But your bond portfolio, if you spent all the money, which of course you do, because it's you spent all the money, you would have gone from 80 to 73. So if you had $800,000 worth of bonds back in 2012, they're only worth $730,000 now. But you were be able to pay yourself some income. The income, look at the income off QYLD is almost 3 times the income off the bond. And both of them had NAV erosion. QYLD had a little bit more. I mean, but you got an income. So, you're trading income for upside with these things. Now, QYLD was first generation. Now that we have things like triple QI, what I would expect after 10 years is to be able to pay yourself and the NAV not be all the way down from 25 to 17. Maybe it's 25 to 23 over 10 years. Maybe it's 25 to 25. Maybe Neos does a great job. Maybe they're able to do it, with no long-term NAV consequences. There's still an opportunity loss because you could almost always just invest in the underlying and usually do a little bit better. But there's reasons there. You can make a good case for both sides. What are you wanting to look at there? You're wanting to look at OVF. What the heck is OVF? That's a bond one, isn't that? I mean, I know that's a benchmark people use to compare stuff to. So I'm going to have to look right here. Oh, no. Okay. This is a lightning spread fund. Okay. These overlay share guys were the first guys to actually do the trade that I know of, that I could find evidence of, to do the trade where they own stock and simultaneously sell put spreads. So their stock is uncapped on the upside. Their put spreads generate income. The trade-off is you get a little extra downside. They don't really have a cushion, but yeah, and that's exactly what I said's right. There's their puts. They've sold the 63, 64, and 67s, and then they're buying the 61s, 62s, and 65s. That structure's creating a credit, but then at the same time, they have full uncapped exposure to the IEFA, and also they have full uncapped to the IEMG. Looks like they have like an 80-20, from big ones to emerging, big foreign stocks to emerging foreign stocks. But heck yeah. So let's see how that one would have done. Now it pays 8%. Yeah, I love these overlay. Marcus, I'm impressed that you know about these. When I was really freaking out about how good the lightning spread is, I did a deep dive on it. And I was trying to find which ETFs are using it. And there's these guys called Overlay. They've been using it since like 2020 or something. And there's guys called in Europe called income shares. And we were talking about income shares on the show yesterday. Somebody was, or maybe it was last night. But anyway, all right. Yeah. So heck yeah, this is going to do much better. This is a second gen covered call fund. This is a much more sophisticated strategy than QYLD. And I would expect it to do much better. So let's check it out. So QYLD versus OVF. It's close. It's close, but it's close. And the other thing is, but also it only paid about half the yield. It looks like it pays 6 or 7 over time. QYLD pays 10 to 12. I mean, you could just see right there, this one was almost $8 of dividends because they both started about the same price, 24.5 to 22.5. It looks like OVF pays about 8 and these guys pay about 12. It's about a third less dividends, but you catch a little bit more upside. So let's see how much money you left on the table in the OVF compared to the market. A little bit, but also the OVF is based on foreign stocks. What was that called? IEF. I always get that one mixed up. IAFE. Now, what was it? We just looked at it. I'm just trying to find out what just an investment in the underlying would have been. We won't worry about the emerging. I'll just look at IEFA. I did put that in there, right? IEFA. Uh-oh. Did not put it in there. Okay. And of course, as per usual, you'd be better off just getting the underlying. But if you need an income, and lots of these funds give you return of capital, which is a little bit of a benefit, defers some taxes a little bit. If you just needed income, you could have just bought IEFA. It's gone from 60 to 90. It's up 50%. well, right? 60 to 90 is 30, it's 50%. But anyway, they have 71% here. I used to be good at math. 60 to 90s, or whatever. Oh, because it also includes the dividend. It's really gone from 60 to 90, and you have $14 in your bank account. So you could have taken all the income off this one. Or, well, yeah, and this one pays a small dividend too. I mean, but that IEFA doesn't look like a bad investment just by itself. You get a little bit of yield. It looks, anyway, OVF. Lots of good choices out there. Lots of good choices. OVF right here is this. Let me show you what OVF is. This is I put it in there because you asked me to, did you? Or OVF. I thought I saw you, Marcus, I thought I saw you say, well, no, you said, what's OVF? Okay. Well, I thought you were wanting me to test it. Okay. This is a company called Overlay Shares, and they do lightning spreads. That's all they do. And this is the lightning spread. I mean, it's the cutting edge right now of covered call strategies, and probably, and also the stacked. Those stacked ones are pretty cool too. But there's a novel approach to covered call writing, combines current income with, well, no, that's not it. Portable income is what this one is. Our flagship active put selling overlay strategy sits atop existing portfolios with the goal of providing enhanced return in income. And they don't say it, but also the goal is not to cap the upside. And so this one came out in 2013. It's $1 million minimum investment. Before they turned this into an ETF, these types of structures were only available to wealthier folks. But I don't know if they've been, let's see here. So let me see. So they have OVL as large cap equity. So this would be the one that I think would be fairest to compare with the Qs or the SPY. So let's look at OVL. Well, first let's compare OVL with QILD. Let's see if you would have been better off in OVL or just a plain Jane, because this goes back to 2019. I would have used triple QI or SPY or something better, but those weren't around back then. So to get a look here, yeah, OVL is in my opinion, it's a superior technology, the lightning spread, the put spread overlay. But now the downside, like I just told you guys, you have uncapped upside because you aren't selling calls. Selling put spreads, though, even though it's a spread, if the market goes down, you're exposed to the width of the spread, and you own the stock at the same time. You actually hold the shares of the stock and do this as an overlay. Market goes down, you get whatever the market's down through the stock, and then you get a little extra. And so sure enough, you look right here during COVID, this thing got up and it was up. What was it up? 10, it's up 75%. Is that right? 10, yeah, something like that. And it went from being up 70% or so to only being up 25%. It lost about 50%. I mean, that was a big, because, these are not great for bear markets, but you can see in a bull market, they do a lot better. Now let's compare OVL to the Qs and see how much money you would have left on the table overall. And I'd expect the Qs to do better, and they do, but, but the Qs don't pay a dividend. You got $13 on 187. It's a small dividend, but in OVL, you got $8 on 24. That's a lot bigger fraction than 13 on 180. Yeah, I love talking about these things. I thought you knew what OVF was, Marcus. I thought that's why you were asking me to do it. EAFE. Yeah. Hey, Mayor, what's up, bud? How are you doing today? It's a beautiful day here in Austin. I'm gonna take Jax for a jog. We missed yesterday. We missed our jog yesterday. So, okay. So Marcus is saying it's IEFA. Yeah, what we just looked at, and an SPX put caller. So the underlines are foreign developed and emerging 80-20 mix with SPY puts. And it's not really a caller. It's a put spread. Well, a put spread by itself is a synthetic caller. So you could say that. You could say it's stock plus yeah, but most callers are stock with a collar. This is stock by itself. And then also the put spread is the equivalent of also having stock that's collared. But so it's like double stock. You're double long between the strikes of the put spread because you have stock, and then you're long between the strikes. It's what I always call it is portable leverage, and no one else calls it this, tactical leverage or something. It's what blocks uses. It's the same technology that makes blocks so beautiful in the bullish market, but it also makes it have a little bit of extra downside in a bearish market. ULTI does a similar strategy also. They do it a little bit different, but anyway, you think the oldest buy right is triple QX. Well, let's just look at that. Let's just run triple QX against the Qs. These old buy rights usually left a lot of money on the table. There's also FTHI is pretty old, a First Trust, high income, but let's go here and let's go back to 2000. All right. Yeah. So 2007. So there's kind of this is kind of the deal. So if you would have just bought the Qs are up over the past, what is that? 20 years, 19 years, 18 years, 19 years. Qs are up 14% per year. Okay. By doing the covered calls, because your upside's capped, you're still up. Your account has some growth in it, but you're only up 5.7%. But if you need the income, and the ideal situation is you should still have some Qs. You have some Qs and you buy a little bit, and you buy some of this like you would a 60-40 portfolio. 60-40 portfolio, you still have growth. You're long 60% in the stock market, presumably growth. It could be whatever. And then the 40% you put in bonds to for diversification, and you can use that money to live off in retirement. Well, bonds don't pay enough to live off of in retirement. But covered call funds could. So, there's the sacrifice right there. That's the difference. It's leaving about 2/3 of the money on the table. What does the core in IEFA name? I wonder, what does the core in, let me look at something there, Mayor. Where was that? So are you talking like we click into here? You mean what does IEFA hold? They have ASML Holdings, AstraZeneca, Novartis, Roche Holdings, HSBC, Nestle, Shell, Commonwealth Bank of Australia, Toyota, SAP, and those are their top 10 holdings. So is that what you're asking? Okay, so Marcus, you're saying iShares wants you to use it as a core holding. What, they want you to use IEFA? I mean, it looks like, let's look at a monthly chart of it. It has all the hallmarks of something you could use for a core holding. It went and made a new high after COVID. It was terrible during 2022, just like everything else was. Even bonds lost money in 2022. Everything. The hedges weren't working. Gold wasn't going up at that time. And it was, interest rates were, anyway, bonds weren't really hedging that much. But yeah, this thing got hurt in 2022. It went from 77 to 51. It's like 30% or something. But then it's been glorious, especially lately. It's gone parabolic at the first of the year, January, February, March. A lot of stuff went parabolic the first year. Materials, oil. This thing was also helped by the tariffs, right? Because it was international. Well, no, this is actually hurt by the tariffs. Well, I don't know. It may have had some of each, but in any event, they've got it. Once Liberation Day came, this thing broke out to a new high. That's the May bar right there. That's a May monthly bar. And boom, just broke out and never looked back. The June bar kind of came back and tested the breakout and then left a rejection tail behind. A hammer. There's a hammer. There's a hammer. Thor's hammer. Heck yes. Heck yes. Now it says it's a core MSCI EAFE. What does the core in the, okay, I'm so sorry. I thought you meant what were their core holdings? Yeah, I think Marcus, yeah. iShares core. Well, let's do this. Let's just watch this. iShares core. Well, I thought maybe you would give us some other, let's just type in core. They probably have a whole line of them, but I thought if I could get part of it typed in there. Okay. All right. Here we go. So here's what they have. They have iShares ISTB, which is 1 to 5 year bonds. They have ILTB, which is 10-year plus bonds. So that means intermediate to long-term bonds. I bet you anything. ILTB, intermediate to long-term. They have ISTB, which means intermediate to short-term bonds, 1 to 5 years. And then they have a core 70-30 conservative allocation ETF. Okay. That one's called AOK. That's kind of the opposite of ONO. You know, that tail risk fund's coming out that's ONO. So you want to buy AOK when the market's going up. And when you go, oh no, you got to buy ONO, I guess. Anyway, so this is a 70-30 allocation. So this is for people that don't want to do their own allocation. Here's a 40-60 allocation, not 60-40. 40-60 would be really, I think, even more conservative. Oh, 30-70 is not 70-30. 30-70 means stocks 30, bonds 70. That would be very conservative. If I click on it, I bet it doesn't. I bet it's not up that much. But you could use it for a core holding if that's what you wanted. Yeah. Okay. You could see it's a lot smoother. It doesn't go up as much, doesn't go down as much. In 2020, excluding that tail, I mean, I don't know if you can exclude the tail. So it went from 36 to, at the worst, 28. It's down 8 points on 36, 86, 24, 32. It's 1/5. It was down about 20%. The market was down 33%. So they did, yeah, because they were 70% bought. But you remember what I was telling you about conservative allocations didn't work. Bonds did not hedge in 2023. Because look, even though this was 70% bonds, it was also because 2022 was an inflation-driven bear market, and it was because of all the free money printing that went on after COVID, and then the reaction to that, whatever. So even a conservative portfolio dropped from 40 to 30. So that's 25%. That's about as much as the market. It didn't really hedge much. In other words, you would have thought it would have hedged because you're giving up a ton of upside because you only have 30% in stocks right here. And you can see your upside since 2009, the SPY's tripled. Or from 2008, it was at like 60, and now it's at 600. This doesn't quite go back to 2008, but this one is nowhere close to tripled. This one has not even really doubled, probably barely doubled, but it's because it's conservative. So let's go and see how the little bit more aggressive allocation did. So the more aggressive one was their iShares Core 40-60 moderate allocation. Then I bet they have a 70-30, or I bet they have an aggressive allocation too. So this one is a little bit less conservative, and this one's gone from 22 to 47. So it has doubled, plus a little bit. And you can see, but and it was down about the same in 2020. Nothing worked in 2022, or I mean, nothing I know of. So let's see what else they have. I bet they have one that's an aggressive allocation. All right, so they have the core, show all results there. Okay, look, they have the core dividend ETF. That's DIVB, core dividend growth, DGROW. We've heard about that one. So core is just their whole line. And then they have their AOR, which is their 60-40. That's their balanced. So that one, if we look at, should do better than either of the other two. And sure enough, it's gone from 58 to, well, actually that's daily. Okay. And sure enough, it's gone from 20 to 65. So it's been closer to the SPY, because the SPY went from 20 to 60, 20, 46. Or no, the SPY's 10x. Okay. Well, this is 3x. The bonds were holding it back, but it's not as held back as the other ones. And even though this is more aggressive, I mean, it still sold off about the same in 2022. So that's AOR. I wasn't even aware of this line. This is iShares is good. So iShares is BlackRock and ProShares is JP Morgan. Is that right? So let's see what else they have in their core lineup. Core California Muni Bond. We don't want any of that. That's trash. Come on, California. So out of their core stuff, they have some dividend, DIVB and DGROW, and then that's all. So and then they have a really aggressive one called AOA, which is an 80-20 aggressive. So that's almost all growth. Let's see how that one's done in the past since the bottom back down here. This one's gone from 17 to 90. So call it 20 to 90. So 20, 40, 60 is 20, 40, 60, 80. That's 4 times. And then 4.5 times plus a little bit more because it was really not quite 20. So maybe 5x, whereas the market's 10x. The bonds are holding you back a little bit, but they also made it where it wasn't too bad. It wasn't as bad in the pullbacks. And you got a little income. I mean, bonds pay a little income. If you have $1 million of this, you're 20% in bonds, you might make 10,000 a year or something, right? Or 20,000 a year. So not great, but that's the case for having some DGROW, which is dividend core growth, which is just dividend stocks. Okay. And it doesn't have as much history, but this one's been doing really well lately. Look, these dividend stocks didn't sell off as bad in 2022. That kind of worked a little bit, went from 55 to 43. That's actually the best. That was the best one we've seen so far. Those dividend stocks, usually dividend stocks are like value plays. They're less volatile. They have less beta to the market. You have Exxon, Johnson & Johnson, AbbVie, JP Morgan, Apple, Philip Morris. I mean, Procter & Gamble, Micro. That's a blue chip lineup right there. That's widows and orphans. So this thing it only pays about 2% per year lately. The SPY pays like 1.3, so it pays more than the SPY. And you don't really have to sacrifice growth, that much. I mean, you're always sacrificing some growth when you pay yourself an income. But all right. So Marcus, what do you want here? Yeah, Marcus saying it's core because it's designed to be a foundational long-term holding. All right. Well, anyway, that DGROW doesn't look bad. What was that? I want to look what the dividend one. What was the other dividend one? Was it DVIB? Yeah, iShares core dividend ETF. Let's see how this compares to the dividend growth ETF. Well, it pays a higher yield. It pays about 2.4%, which is not great, but in 2022, it hedged, it was pretty safe, dropped about 25%. That's not really that safe. All right. Well, all right, Marcus, what do you want to look at? OVF versus NIHI. Yeah, good one. Good one out there. All right, so this goes back only till September of last year, 2025. I mean, OVF is +6, NIHI is +3.25. Dividends, let's see if there's a dividend difference. It's about the same. It appears to look close. OVF's a little bit more. Yeah, I like OVF. I mean, I like the idea of it. Let's check out OVL. I just like those large caps. Let's check out OVL against the SPY. And let's just look over the past. We'll look at the most recent bull market, which is going to be late October. I think that the lows are always set right around Halloween. I swear. I think the low for that move was right around the end of October. We also had a low in 2023 that was early November, late October. October is just kind of a tough month for the market, but but November, December traditionally have been a little better. All right, so let's just look at kind of the last bull run and see how much upside OVL's caught versus the SPY. And then we'll compare it to some covered call funds and see which one's a better deal. Okay, so OVL is just sticking to the SPY really well. I mean, and OVL pays a bigger dividend than the SPY. So now let's compare something like OVL. Now it just pays 7%. So that's not a lot. But let's compare it to something. Let's compare it to JEPI, which pays like 8%, but super steady. And it's been around. I think JEPI came out in late 2022 or maybe early. Yeah, JEPI was out at the time. Okay. So there you have it. JEPI paid 8%. OVL, let me check OVL again. OVL in the most recent years paid it's only paid 5%. So, I mean, you know, JEPI is paying 8. There's a big difference between 8 and 5. It's like 60% higher, 60% higher than 5. So I can kind of excuse this underperformance a little bit. But OVL could work. I mean, it's an upside monster, you know, those lightning spreads. I'm obsessed with those lightning spreads, guys. All right, what else you guys want to talk about? If there's no other questions, I'm going to take Jackson for a run. It's kind of chilly today in Austin. It's perfect running temperature. It's like 60 or something, 65. I mean, not chilly, but it's not 80. Tell you the truth, and Jackson is kind of, I mean, when it's hot, I guess because he's a little bit overweight and he's you know, has fur. But we were jogging the other day. It was like 89, and I was dragging him the whole way. You know, most dogs will jog beside you on the leash or sometimes in front of you. At Jackson, my hand was back here the whole time. I was going, come on, buddy. Come on. And he was just loafing out. Anyway. All right, guys. I think he'll do a lot better today because it's nice and cold. All right, so let me say my goodbyes to everybody at Oracle. I appreciate the compliment as much as anything else. I like that you like this kind of content. Yeah, listen to it later and see what else. But I appreciate all of you guys. Mark, Zenful Rocks, Skeptic, and there's 23 of you guys here. So there's people that aren't talking. Mayor, you stay safe where you're at in the world. Hopefully that situation ends soon. All right, guys. Hey, thank you so much. I appreciate it. Let me do my disclaimers. Remember, it's not financial advice. Consult a professional advisor. And I'm not even going to show my PayPal because Oracle paid for all of you guys. I mean, if you want to pay me, you still can, but you have to go look at my PayPal somewhere. No grifting today. All right. Everyone thank Oracle. He bought beers today, essentially. All right, guys. I'll talk to you later. Have a good day.